Welcome to The Explainer. You know, if you just glance at the global economy right now, honestly, it looks like pure chaos. But if you zoom in, if you look at the micro level of financial technology, we're actually discovering a completely different story. Today, we're looking at three fintech giants who are totally ignoring the macro noise and hyper-focusing on building the foundational plumbing of our future financial system.
To really appreciate what these companies are pulling off, we've got to look at the backdrop they're operating against, because it is a highly chaotic macro environment right now. Gas hasn't been this expensive since 2022, currently sitting at $4.52. The Strait of Hormuz remains closed. The U.S. is technically at war. Former President Donald Trump is on Truth Social, calling Iran's ceasefire proposal totally unacceptable. This is the stark reality of the global stage today. But here's the wild part. Despite all of this geopolitical tension and economic friction, the S&P 500 just closed at an all-time high anyway. While the macro environment is doing its chaotic thing, three major fintech companies decided today was the perfect day to make some serious moves.
Okay, let's dive into our roadmap for today so we can break down exactly how these companies are quietly building this infrastructure. First, Wise killing the wire. Second, Circle's $3 billion hedge. Third, SoFi unlocking the IPO. And finally, the new fintech infrastructure.
All right, let's hit number one. Wise kills the wire.
Wise just officially began trading on the Nasdaq under the ticker WSE. And this is exactly 15 years after CEO Christo Kamrant first pitched the idea that, hey, banks are absolutely robbing you on wire fees. And they've totally backed it up. Wise charges an average fee of just 0.52%, which is crazy low compared to the global industry standard sitting somewhere between 3 and 5%. Because of that massive difference, they processed $243 billion in cross-border volume in fiscal year 2026. That's up 31% year over year. They're serving nearly 19 million customers and hitting $2.5 billion in net revenue. Oh, and 75% of their payments arrive in under 20 seconds, literally faster than sending a text sometimes. So they aren't just cheaper, they're fundamentally faster.
So what does this actually mean for the U.S. market and, potentially your own wallet? Well, $43 billion. That is the massive prize of U.S. hidden fees expected in 2026 alone. Wise wants a piece of that market. And by listing on the Nasdaq, U.S. retail investors just got a direct way to bet on the death of this whole wire transfer ripoff. The market definitely saw the value, sending Wise shares up almost 12% on the day. They're basically taking a $43 billion consumer headache and turning it into massive enterprise value.
Moving right along to number two, Circle's $3 billion hedge.
Circle just dropped their earnings, but I gotta say, the real story here is completely buried. There's a lot of nuance in these numbers. They reported Q1 2026 earnings per share of 21 cents, which beat analyst estimates. But revenue missed consensus at $694 million. Why? Well, it's because the Fed has been holding interest rates flat all year. That puts massive pressure on Circle's reserve income, dropping their reserve return rate to 3.5%, which is a 66 basis point decline year over year. So the miss is real for sure, but it completely masks the actual story happening under the hood. Now here's the real story. On-chain transaction volume for Circle reached an absolutely staggering $21.5 trillion. That is a 263% jump. At the exact same time, USDC in circulation hit $77 billion at quarter end, which is up 28% year over year. To put that into perspective, according to Visa data, USDC now accounts for 63% of all stablecoin transactions globally. When you're processing over $20 trillion and commanding that kind of market share, you aren't just a product anymore. You're global financial infrastructure.
And because they're infrastructure, they just can't afford to be completely reliant on the Fed. So, Circle quietly announced a $222 million pre-sale tied to a new Arc blockchain network valued at $3 billion. And get this, the backers include BlackRock, Apollo, ARK Invest, and A16Z. It's wild to see a syndicate this powerful. This is basically the ultimate hedge. It's a second growth engine designed specifically to generate value completely independent of what the Federal Reserve does with interest rates. Think about it. They beat on EPS, missed on revenue, and quietly raised a war chest from the most powerful investor syndicate in crypto, all before 9 a.m.
Okay, let's pivot to number three. SoFi unlocks the IPO.
SoFi just agreed to acquire the assets of a British company called PrimaryBid to bring their tech to the US. And to understand why this is such a genius move, we really need to look at PrimaryBid's valuation history. Back in the wild hype cycle of 2022, when basically everything was a unicorn, they raised a $190 million Series C led by SoftBank. But fast forward to our current reality, and that valuation was written down 87% by LSG right before this acquisition. SoFi is smartly buying the foundational tech, the actual picks and shovels, at a massive discount. They aren't paying for the 2022 hype. And what does this tech actually do? It lets everyday retail investors participate in IPOs, follow-on offerings, and block trades, deals that have historically been totally gated behind institutional walls.
It's all about completing the ecosystem loop. Think about it like this. Step 1, SoFi already has your banking. Step 2, they have your lending. Step 3, they have your standard investing. And now, Step 4, by adding Primary Bid's tech, they have IPO access. By integrating this platform with their Galileo and Technisys units, SoFi is building a capital markets infrastructure layer that they never had before. CEO Anthony Noto calls this a natural evolution of their platform strategy. And make no mistake, by completing this loop, they are directly challenging Robinhood, who's been trying to build toward this exact same all-in-one ecosystem just from the other direction.
Which brings us to our final point, number 4, the new fintech infrastructure.
We've looked at Wise, Circle, and SoFi today, and the absolutely crucial takeaway is this. None of these companies are merely consumer apps anymore. They're building distinct foundational layers of infrastructure. Wise has built the cross-border payments layer, giving U.S. investors a seat at the table to basically kill the traditional wire transfer. Circle has built the stablecoin blockchain layer, proving they're a $21 trillion infrastructure play while completely hedging against the Fed. And SoFi has built the capital markets retail layer, scooping with the technology to put everyday investors right inside the IPO room for good. These aren't just apps sitting on your phone. They are the picks and shovels of the new global economy.
Which leads us with one incredibly provocative question. Are traditional banks already too late? While the old guard is distracted by macro chaos and geopolitical headlines, these fintech giants are quietly replacing the plumbing right underneath them. Just a quick reminder, this explainer is for information and entertainment purposes only, definitely not investment advice. If this breakdown changed how you view the market, be sure to subscribe to FinTech Stacks for the daily signal. Oh, and share this with a coworker who still thinks wire transfers are free. Thanks for focusing in with me today, and keep learning.